Okay, hello, it's Rhonda Thomas. This is Managerial Accounting, and we're just about ready to do Chapter 11. Chapter 11 is called Differentials and Pricing, okay? Differentials and pricing. So the first 6 items in these basic problems is going to be a decision that needs to be made at a company, right? I'm sure you've heard of a pro and con list, right? When you're trying to decide about something. So that's kind of what differential analysis does. It says, should we lease the equipment or should we sell it? And then what's the differences between the two options? So the goal of what we're going to do here in these intro problems is to look at a business decision and see if we can actually quantify it, right? Put it down on numbers so that we can justify a decision, okay? Because if you decide to lease equipment, then somebody around is going to say, how'd you figure out how to do that? How'd you figure out that was a good decision? Well, you better have your analysis to say, well, here's what my analysis showed about this decision, okay? Now I'm going to put this on. So there's a couple of different decisions. So I'm just going to run through these real quick. Lease or sell. The second one is, do we discontinue a segment of our business? If a certain segment is showing a loss, should we eliminate it? And believe it or not, sometimes you don't, because believe it or not, that even though it's operating at a loss, it's preventing us from having an even deeper loss in another way. Okay, so that's kind of the idea of looking at that. The third one is a make or buy decision. Do we make the bottles or do we buy the bottles, right? So you got to go through the costs. Some you got to look at costs, some you got to look at revenue, some you look at both. Just depends on the decision that's being made. Here is a decision to replace equipment, continue with the old machine or replace it, okay? This is, do we process it further or do we sell it now? Now, we had a little bit of this one back in another chapter. I always think of trees. I always think of trees. Here's a tree standing up. When we cut that tree down, do we just sell it as the log or do we sell it into whatever that log can become, like 2x4s and whatever else would come out of a log, right? Of wood. It would depend on the wood too. So do we sell the product or do we process it further to make it even more valuable? And then the last decision is what they call a special price option. Some businesses may be asked to sell their product at a really low sales price. Let's say a nonprofit. Let's say I'm trying to think of a good example. Let's say McDonald's here in town decided to give those of us who work and go to school here at Butler a % off, right? A % off. So McDonald's would have to sit down and go, well, let's see. We're giving Butler folks a special price of what we're selling. Let's make sure we don't become a loss because of it. Okay, we want to make sure that we can do a special price order is basically what that is. And then the last two have to do with how to calculate a price of something. There's one called the product cost markup, and then there's one called a bottleneck profit. Okay, bottleneck profit. So in my opinion, these are kind of fun, but you do have to pay attention to the details. Okay, so let's go back to number 1. Okay, and we're going to be making some tables. So hopefully that's not a problem for you. Make some tables in Excel. Okay, so let me go get my spreadsheet and pray that it saved okay from last night from my house. So let's see. Spreadsheets. Chapter 11. Hey, it did. That's good. All right. Okay, so what I'm doing with my spreadsheet is, once again, we just named all of these, right? These are the different business decisions. Differential analysis for decision making is basically for accounting decisions. Okay. So I'll just put for accounting decisions. Okay, so once again, that leasing or selling, discontinue an unprofitable segment, manufacturing or purchasing a needed part, replacing a fixed asset, selling a product or processing it further, and accepting additional business at a special price. So here's where we're at. First one is about whether we lease or we sell something, all right? So I have a little table here that I'm going to try to use to do my calculations, because of course, Connect doesn't allow you to do calculations. Boy, I wish it would. That would help a lot, but it also gives you more practice of using Excel too. So we're the Felix company. We own equipment with a cost of $361,300 and accumulated depreciation of $56,800. Now this equipment can be sold for $277,200 less a 5% sales commission. Woo, okay. So when we get, all right, so alternatively, Felix company can lease the equipment for 3 years for a total of $288,100, at the end of which there is no residual value. In addition, the repair, insurance, and property tax expense that would incur, remember, incur just means that it happened, by the Felix company on the equipment would total $15,200 over the 3-year lease. Okay, so we've got to put some information in for each side of this, okay? And we're kind of look at this example while we put our stuff in here. Okay, so we have lease. So I'm going to put lease here. And then we have sale or sell, and then we have the differential. Okay, so all right, so let's put lease. Let's just line it up like they are. Lease, sell, and then the differential. Okay, and this is the differential as of the alternate, the second alternate. Okay, so let me put this unmerged here. There we go. Okay. So once again, this is alternate 1, alternate 2, and this differential is looked at on the side of the seller. Okay, decide to, all right, to sell, to lease or to sell equipment. Okay, so okay. Prepare a differential analysis on October 29th as to whether Felix company should lease or sell. If required, use a minus sign to indicate a loss. So anytime we have a negative number, we want to be sure to put in a loss, or put it in as a negative, because it's going to represent a loss. Okay, so you say, well, I don't see any sales numbers here. Well, here it is. It can be sold for. So if you own the equipment, right, we're going to put this under the sale or the sell column, and then we'll put it over here. All right, so let's put a positive number. And remember, some of these differential analysis is going to require revenues and costs. Some are just going to require costs only. So we got to look at revenue from the revenue point of view, if it's positive or negative, and then costs, positive or negative. So remember, costs are opposite of revenue. So I'm going to put this sale in. The sale is 277,200, and I'm going to put it on my sheet as well. Okay. All right. And then here is the alternative for leasing. So it goes here. Okay, leasing 288,100. And it goes here, 288,100. Now we're going to subtract. Okay, we're going to subtract here. It's the differential effects. Okay, and because this is revenue, we got to look at it from, remember, we've been looking at it from costs more than anything. Let's go ahead and put our costs in, and I'll explain which direction things are going. Okay, so the costs, okay, it said for, okay, it says the lease is going to have a cost of repairs and property tax and so forth of 15,200. So we're going to put that in as a negative. Okay, 15,200. And now we can calculate a profit or a loss, right? So let's go ahead. Let me put my cost here, 15,200. Okay. And now let's see about the cost for selling. Okay. The cost for selling. All right. Here is, if you own the equipment, the cost to us was 361,000. Okay. Oh, it's 5%. Okay. So we got to go to this 5% thing here. 5% of what? 5% of the sale, correct? We got to subtract that. If we're in the selling column, we need to take 5% of 277,200. So I am going to move this down a minute. And I'm going to put that number up here because the result of that number is going to go right here. Okay, so they said that the sales price here is 277,200. And then we want 5% of that for commissions. Okay, 5% of that for commissions. Okay, this is 5%. Oops. Commission. All right, and then we'll do the math here to find out what that 5% is. All right, so 277,200 times 5% is 13,860. That number goes here, but it goes in as a cost. Okay, it goes in as a cost. Can you guys tell me if you're following what I'm doing or a different number? Is it an algorithm problem, or are you getting the numbers I have?
I'm doing quizzes.
You're doing quizzes.
Yeah.
So you've already done this?
No.
Why wouldn't you be following along?
Because these things are due tonight.
Oh, okay. I live with that.
I'm doing accounting.
I believe it. And I don't, I get it. Okay, sorry, I was just
Sorry.
trying, no. I was just going, well, okay, got it. Do what you must. I understand. Okay, so we're gonna put that in as a negative. And it doesn't bother me now that I understand. So don't worry. Okay, so, all right. So here's the thing, this alternative number two, it's less in revenues, isn't it? So what you have to do is you have to subtract the sale. So you're going to take the amount of the sale and subtract the lease equipment. Okay, that's going to give us a negative 10,900. Okay, so let me just double check my math here. Okay, I'm gonna start with the sale of what we're doing and subtract the lease. Okay, so that's 10,900 as a negative number. You say, why is that negative? If I would have taken lease and subtracted the sale, well, when you're, whatever alternative you're using, that's the one you start with and you subtract the other. Okay. To me, I would have just put a sale on this side. Anyway, I'm not going to do anything. That we're going to follow the book. Follow the book. Okay, so now let's do a differential between these two. Okay, so the good news is this alternative is actually lower in cost. Okay, so let's see here. Let's take and subtract. Let's see what we get. Okay, there it is. Okay, so once again, please remember that this is a revenue, and lower revenue is unfavorable, right? Lower revenue is unfavorable. So I'm just going to put that next to it so that you can think about it a little bit. But lower costs are actually a good thing, okay? But looking at it from this point of view, favorable is lower costs. Okay, so now we're going to calculate. All right, we're going to put this in. So this is a positive number. Now we're just going to add down, right? So we just go across here. Okay, so now that we know what our numbers are based on the two alternatives, okay, and if you take a minus 10,900 and add 1340, you get a negative 9,560. Now, this means that this alternative is going to create it compared to a lease. The sale alternative compared to the lease ends up with a loss. Okay, ends up with a loss when we do the differential of this. All right, so I want to check my work. So if that's the case, I think we better lease, right? How much is in profit in lease? 272,900. How much is in profit for the selling option? 263,340. Which one would you take? The lease. Yep. But like I said, you gotta look at revenues and costs carefully. Okay, very carefully. So there you have it. Okay, moving on. Moving on. All right, the next one is going to be to discontinue a segment. Okay, so if we put some things together here, and I wanted to show you this example. Okay, so this example is a cereal maker. Okay, they're making cereal here, and they've got bran flakes. Oh, what do we got here? Oh, to continue the bran flakes or discontinue the bran flakes. Okay, so we've got to put information in. I assume they're making bran flakes right now. Okay, so we're going to put in the information about continuing on, and then we'll put in anything that gets eliminated because of discontinuing the bran flakes. So let's get started. Product Omega has revenue of 195,000. Okay, so that's going to go right here. This is Product Omega. Let's put it in. It is 195,900. Okay, I'm going to put that in here too. So I've got continue, discontinue, and differential. Okay, so continue, bran flakes, and discontinue bran flakes. Okay. So let's go ahead and put in what they're saying. All right. They're saying has revenue and variable costs. So the revenue of continuing the brand flakes is 195,000. All right. And then we're going to break down the costs. We have cost of goods sold, variable selling, and fixed costs to create an operating income or loss. Okay, so here's how we're going to put it in. So we've got the variable cost of goods sold. I think I'm going to have to expand this down at least one. Okay, yeah, insert. Okay, so our variable costs are our variable cost of goods sold. Okay, and variable selling. Okay. All right. Hello, Casey and Molly. Good to see you. All right, so let's put the numbers in. Now we're going to put these in as negatives. Okay, I got 114,000 for the cost of goods sold. Variable selling is 33,400, and I got to put that in as a negative. Okay, and then the fixed. Okay, fixed costs, 58,800. Okay, and now we're ready to see if we have a profit or a loss. Well, revenues is definitely being outweighed by the costs here. So let's just find out how much that is. Okay, so we're going to include the revenue, bring it down, and we're showing a loss of $10,300. So this is what we're showing is currently happening. Okay, so I'm going to put these numbers in. And then the loss is a negative 10,300. Okay, so I believe we're okay there. Yep. Now what's the alternative? Is to not sell, right? To discontinue the brand flakes. Well, when you discontinue, is there any revenue? No. So we put a big fat goose egg there. There's no cost of goods sold. There's no selling, but what still remains? Fixed. Okay, fixed. Okay, fixed still remains. In fact, fixed will if we decide to, okay, so let's put a negative here to represent that those fixed costs still go on, even if we discontinue the brand flakes. What's going to happen is that amount of the fixed cost is going to have to be spread out over the continued cereal lines, and then they're going to end up with less of a profit. Okay, so if you add down, all you have is this one to put right here. Okay, so go ahead and do that. Okay, so I'm going to make it stretch all the way up here, just in case I ever put something in the middle. And now we're ready for the differential. Okay, the differential based on the discontinuing option. Okay, so the differential effects, that's what they call it. Differential effects. Okay, and so if the idea is, okay, so if we take 0 and subtract 195,900, we've just lost that much revenue, right? So this is going to go in as a negative. That's how much revenue we've lost if we discontinue it. Okay, now the thing is, whatever the sign is over here, the opposite sign will go here. So just like getting rid of this revenue, we will also get rid of these variable costs, right? But we won't get rid of what? Fixed. Okay, fixed is actually going to be, oh, I'm sorry, there is no difference with fixed. You subtract this one from this one. These are the same number. So there is no difference in the fixed costs, okay? The fixed costs won't change. Okay, so that's why this is going to be 0. So that's why it's 0, but these will have the opposite effect. So if we take this and subtract this, wrong one, just a second. Okay, so there's none of that. Okay, so we want this minus this. Okay, you get a positive number. Okay, so you're just going to bring it down. And what do we have sitting here? By eliminating the bran flakes, what's just happened? Well, now remember, with the bran flakes, this is what the profit was. It was a loss, but now it's even worse. So it's a worse loss because we just eliminated a line that was some profitable because it just couldn't cover all the fixed in that area, right? It almost did, but 10,300. So maybe there's a way we can cut costs or raise the price to get this out of being a loss. But it looks to me like our loss is going to be even greater if we eliminate the bran flakes line. Okay, so let's key this in. You understand what we just did? If you don't, let me know. I'll try to help. Okay, so I think it's interesting, this analysis stuff, because it shows you that you would think that the whole problem was bran flakes, right? Nuh-uh. There's more problems than just bran flakes. Bran flakes is actually helping us not be so low in our loss. Okay, and sometimes when you make decisions in a business, you don't realize what may happen. Oh, I forgot to put these in as negatives. Sorry about that. Okay, wait. I got the right number. Okay, let me see if I'm still okay. Okay, good. All right. So once again, this is negative 58,800 because the fix didn't change. It's the same. And then we put a 0 here. Then we're going to add down and we get a 0, 48,500. So once again, our loss is even deeper without the bran flakes. So what do you think we should do? Let's continue them. And maybe, like I said, maybe we can have Managerial work on getting their costs down. Maybe we need to figure out this fixed cost. Maybe it shouldn't be equal across the different cereal product lines. I don't know. But we're not going to discontinue it right now, okay? Because right now it makes us go in the hole about 4 times that amount. Yeah. So we'd rather have a smaller loss than a bigger loss, in other words. Okay, moving on. Okay, this next one is called a make or buy decision. Okay, make or buy. Now, what are we looking at here? Can you tell? We're just looking at costs now. Okay, make or buy is all about costs. There's no revenue showing here. Okay, there's no revenue showing here. So I'm going to go ahead and put these titles in. Okay, so we need 1, 2, 3, 4, 5, 6. Okay, so let me add a couple more here. Okay, so all right, so the first one is to make the bottles. And maybe that's what we already do. Usually the first scenario, we're doing it. We're doing that now. Okay, and usually the other alternative is one we're thinking about doing. Okay, and then the differential effects. So we have a purchase price. We have freight. We have variable costs. We have fixed manufacturing overhead. And we have total unit costs. Okay, so I'm going to put a line here. I see what I do. Put that up here. All right. So now we are ready. So we'll have unit costs, total unit costs, as our equation. That's what we're trying to find. So that one's going to go up here. All right. So let's see if we can find out the information about these bottles. So we manufacture various size plastic bottles for its medicinal product, okay? Medicine. The manufacturing cost for small bottles is $168 per unit. So that's the manufacturing cost, and it includes fixed cost of $37 per unit. Okay, so down here under make bottles, right? Weren't we just given how much it takes to make 100 bottles? Yep. So down here at the bottom, we're going to put $168. Okay, that's how much it takes to make 100 bottles. And we're doing it by the case. All right, so let's go ahead and put this in. All right. And then they said something about the fixed part of this making the bottles. So $37 a unit. And by the way, we're trying to get to a unit cost that it costs us to make these bottles. So I'm going to put 37. Now remember, these are all costs. So we're just putting them in as positive numbers. Okay. And then we've got to find, by the way, freight or purchase price is for when we buy bottles. So there's not going to be a purchase price under the make the bottles. Okay, no. Okay, so put a 0 there. And then the freight is also for having what you purchased shipped, right? So all of these should be dollars now to go together. All right. And then what we'll have to find is the variable costs. Okay, so then it says, a proposal is offered to purchase small bottles from an outside source for $99 per unit. $90 per unit plus $8 per unit for freight. So per unit, okay, is 99 and 8. Okay. All right. So there shouldn't be any variable costs if we buy bottles, right? Because that's coming from a vendor. However, fixed costs are going under either one. Okay. So now we need to come back to find these variable costs. Okay. Can we find it? Does anybody know how to find variable costs? If these two get added up to 168, then this is going to be 168 minus 37. Good job. Okay, so let's see what we got here. Okay, so we're going to subtract to back our way into a variable cost. Okay, that's called backing your way in. And now we need a total here. Okay, because we put this total in manually, right? We put it in manually. If we wanted to check it to make sure it's operating okay, we could. Let me see here. But the variable cost, oh yeah, I can't. Okay, so let me put this back. Okay, so once again, when we're making the bottles, it's costing us $168 for a a case of 100 is a unit. And if you want to, just in case, that's interesting, just in case, I like to make note. So 100 bottles equals a unit. Okay, it's good to write that down because there may be a time that they want us to go find out how much it is by the bottle, right? And then we would be able to do that. All right, so I'm going to put this information in. Okay, so there is no purchase price. And I'm just going to put in this column first. There's no purchase price or freight because we are making the bottles. The variable costs are 131. Okay. Because we took the total and subtracted the fixed manufacturing overhead. So I'm going to put this in just like I would have. And then we ended up solving for variable. And I'm going to highlight what we solved for, just so we remember that that was not given to us. Okay, we had to find it. Okay, now we want the effects, right? We want the effects, and we want to take the second alternative and then subtract the bottles that we're making to find our differential. Okay, to find our differential. So let's see, let's take this and subtract 0, and we should have 99. We do. So that goes also for the freight. Okay, and then we're getting into the variable costs. Yep, and then there's no difference between 37 and 37. So now we're going to add up the 99 and the 8 and the negative 131. Okay, we're going to add it up. And if we have a negative number, okay, if we have a negative number, and remember, these are costs, okay, and this was a cost, okay, I could have put all these in as negatives, that might have helped, but do we want something that costs us 168 or 144? We want, this looks like the better option. Okay, it looks like the better option to buy the bottles, get rid of the equipment, but we would also have to get rid of who? The workers who are making those bottles. So
Saves even more money.
saves even more money, I know, but all right, so let's plug this in. Okay, so actually, I'm gonna do this a little bit different. Hang on. I am gonna make these negatives. Nope, because costs, oh well, you just gotta look, you just gotta think about what you're looking at. That's how you answer. Okay. And I think when you look at these two numbers, this may not tell you, right? If this is a cost, a negative is favorable. Remember that? Yep. So this is favorable. And then let's just key in what I got. So 131. So it was actually beneficial to make them when we were looking at variable costs. Okay. But, and like I said, we're looking for the lowest of the costs, not the revenue of it. Okay. So like I said, it sometimes takes a little practice to do this. So I'm going to put negative 24 here and see what we get. All right. So I think here's all our most better cost, right? Better cost to buy the bottles. Maybe we need to go test the quality of the bottles. Maybe, I mean, there's just different things that we might think about before making the decision, but this is definitely putting us on the path to buying the bottles. Okay, buying the bottles, putting us on the path. Whoop. Let me check it, make sure I'm right. Do I have any red marks? Okay, no. But you really had to concentrate on the fact that this was costs only, not both. Okay, next one. How about replacing equipment? Replacing it. Do we keep the old or get something else, right? So here is an example of doing that. Okay, so you have continue with old machine, replace the old machine. So this is the old and this is the new. Okay, and then the differential that you get, you take the new, you take alternative 2 and subtract alternative 1. Okay, so let's go ahead and see. All right, so my first one is revenue. Okay, replace. Let me see if there's anything. Okay, machine with a book value of $248,000 has an estimated remaining life of 6 years. So that machine should be able to be depreciated 6 years, right? A proposal is offered to sell the old machine for $216,300 and replace it with a new machine at a cost of $282,200. The new machine also has a 6-year life, which I find weird because why wouldn't, okay, anyway, all right. A new machine also has a 6-year life with no residual value. So if we hang on to that piece of equipment, it may last us 6 years. And at the end of that 6 years, I guess we can't even sell it for scrap. So I don't know, but that's what they're saying. The new machine would reduce annual direct labor costs. Okay, so this new machine is going to take the place of some direct labor hours, and it's going from 49,400 to 39,500. Okay, so let's go ahead and put this information in. So I'm going to put proceeds from sale, proceeds from sale of old machine. Okay, and then we want keep. I would say keep or replace. Okay, but they want continue. Okay, continue with old machine. Okay, and then this is replace old machine. I would say buy a new one, but oh well, that's okay. Replace old machine. And then our differential effects. Okay, so let's see what we can line up here about each of these scenarios. So if we sell it, right? Proceeds from the old sale. Proceeds from the sale of the old machine. Well, if we're keeping it, there is no revenue, right? So the only scenario where we would actually sell the machine, right, is the replace alternative. So this is going to be 0 here. Okay, 0. And then this is going to include that 216,300. Okay, 216,300. Now I'm going to put this in, and these are proceeds. So this is money coming in. Okay, money coming in. So it's going to go in as a positive number. Okay. Under costs, we should have a purchase price. Gosh. And we have a purchase price and a direct labor. Okay, because it is saving us some direct labor. So we have to figure that in too. And it's for 6 years. Okay, and then we're going to have either a profit or a loss. Okay, so we'll put the equal sign down here. So once again, the revenue from selling the machine, there is none if we keep it. And, oh, we've got that there. I've got that under, yeah, down there. All right, so now let's do the replace minus the continue, okay? So replace minus the continue. All right, so that is 216,300, not a stretch. Let me make these all dollars now. Okay. All right, now let's go to cost. Okay. Okay, the purchase price. There is no purchase price if we continue with the old machine, but the new machine is going to go in as a negative 282,200. Okay, so this one's going to be replace minus continue. Okay, so it's in there as a negative. And then the direct labor. Okay, the direct labor. All right. So it says we'll reduce direct labor costs from 49,400. Okay, so we're going to put the costs in for direct labor. Direct labor with continuing the old machine is going to be a negative 49,400. And then the new machine would have direct labor of 39,500. Okay, now we're just going to, I got one here. Just a second. So that is 296,400. Okay, so the 296,400, that's, and believe, the thing we forget, this is going to be for 6 years. So we really need to take both of these numbers times 6. Okay, so that's why it's got the 6 years there beside. Okay, so I'm going to put 6 over here. And then, okay, so let's go equals of 49,400 times 6. Okay, and that's going to be a cost. So it's going in there as a negative. And then this one is going to be a cost of 39,900 times 6. Okay. And then, all right, so now we're just going to add down whatever is here. Okay, and we're going to bring that to each column. And I've missed one. Hang on just a second. Hang on just a second. Okay, I got to go back to this one just a second. So that's good through there. So the 237 is actually 39,500. Sorry, 39,500. I put the wrong number in. 39,500 times 6. Okay, that's going to save us 6 years of direct labor, and that needs to go in as a negative because it's a cost. There, that's better. Now let's do, okay, there we go. Yes. And then this, okay. We need a difference between these two. This one minus this one. 59,400. So now let's add, and we're correct. It goes this way and this way. Okay, so here is your profit or loss. Okay, this is your profit or loss right here. Okay, so which one is more of a loss? It's this one, to replace the old machine. So what do you think we're going to do? Keep the old one. Keep the old one because we're actually going to have more of a loss if we replace that with that particular one. Okay. All right. So let's key this stuff in so that it reflects in the problem. You know, if I was gonna replace a big tractor or a big piece of equipment or something in my business, I would take this in and go, look at what, if I buy this from you, I've calculated this. Can you help me with the price of that sale? Right? Or at least have it in your mind, right? So anyway. Okay, so once again, those direct labor costs, we do have to remember to take those times 6 years. Okay, and then that those a 59,400 and then negative 296,400, go to 900, 6,500. Okay, so should they continue with the old machine? They should continue with the old machine based on this information. Yep. Because which one is a more cost, more of a loss? Here's your more loss. Okay, yep. Okay, we're cooking through these pretty good. Let's keep going. All right, now we're going to decide whether to process something further or sell it at a certain point. All right, so this is going to be, okay. All right. So what we're going to do is, I'm going to put down what we need here. So this is going to be sell product Tango, process further into product Zulu, and then the differential effects. Okay, so these are our two scenarios. So we must already do the selling at product Tango. Okay, and then process further. In fact, this used to be called process further in my mind, and that they always use the word further when they use the word process. So further into product Zulu. Okay, and then the differential effects. All right. The first thing we want are revenues, and we need it by per unit. So we'll be careful with that. Revenues per unit. Okay. All right. And then we need cost per unit and then profit per unit. So sometimes you got to get it down to that for some of this. And then profit or loss. And we need an equal sign here. Okay, let's see what, okay. Product Tango is produced for $3.58 a gallon. Okay, so that's a cost. Okay, I'm going to put, let's see here. Okay, so we can start putting in costs because I think, so we're going to put this in, 358. And that's to produce the product Tango. Okay, so that's going to be, right, so let me make these into dollars. Huh? Okay, that's good enough. Okay, 358. All right. Product Tango can be sold without additional processing for $4.21. So we're going to put $4.21 here. Okay, and then we will have our profit. Okay, so we do show a profit here of 63 cents. Okay, now the other one is the Zulu. Okay, Zulu. Usually it costs more to process something further, right? And they say that additional 38 cents per gallon. So I'm going to take this number and add. Okay, so we're going to add to the price. So it's should be, let me see what I got. Nope, other direction. Sorry. All right, so we're going to subtract. Okay. Yep. So there's the cost with that extra 38 cents in it, but we can sell it for $4.54, right? Okay, so now let's see which one has more of a profit per unit. Okay, I'm showing that my original idea, right? So let's go ahead and do. So let's take the new price and subtract the old revenue. So yeah, we could sell it for 33 cents more than we're making, but it's too much cost in between. Okay, so with the new one, we got 38 cents of cost and only 33 cents of revenue. Okay, so I think we're going to sell product at Tango. All right, and so the differential is a negative 0.05. And remember, anything negative is what? A loss. So if this creates a loss, all you got to do is look here. That's the profit. So we're losing. Yes, we do still have a profit, but the profit, we are losing 5 cents of every unit if we decide to process it further. Processing it further should bring in quite a bit more revenue. And that's what we need to make that process further happen. So let's go ahead and key these in. I'll try to hurry up a little bit. Okay, 454. Okay, so what did we say? Should it be sold or processed further? We better sell it just like we've been doing, or we're going to have less profit per unit, right? And a nickel could make a difference. How many do they sell? They didn't tell us. Okay, let's keep going. Now we're going to do the last differential. This is to reject or accept a special order. Okay, special order. So you've got a nonprofit calling, wanting to buy your product at a much lower sales price. And so let's see what they tell us here. So for instance, we have revenues, costs, and profit and loss. Okay, so let's put, and then this is going to be to reject the order. Reject the order, that's going to be the norm because normally we don't sell at that price. If they're wanting, it says that we normally sell it for $48, but somebody's come in and asked us to buy from us at $32 each for the export market. The variable production cost is $24 per unit. An additional export tariff, oh my gosh, of 14% of revenue must be paid for all export products. Assume there is sufficient capacity. There's where I was going to take you guys. See that line right there? Okay. And we didn't get any numbers of how many they're wanting to buy from us at $32 each, but they are telling us that we have enough capacity in our manufacturing to handle this order. If we didn't have any capacity to do it, we would probably reject it right off the bat. Okay, so anyway, all right, so we're going to either reject it or accept it. And I'll walk you through this. Okay, so and then the differential effects. I do like how they do this in this book. I've seen it done quite a bit differently, and it seems like it's a lot more straightforward. So that's a good thing. Okay, we want to start off with revenues. And then we have costs. And then variable costs. Variable manufacturing overhead per unit. And export tariff. There's a tariff for you. Well, tariffs are basically taxes. I don't care what the media says or anybody else. Okay, and then we have profit or loss to come to. Okay, all right. So once again, the revenue is $48. Okay, the special order is 32. Okay, so we can do the difference here. If we do the difference, it's going to be a negative, of course, because we're thinking about selling it to them for per unit. Okay, per unit. So wait a minute. Okay, revenue to reject the order. Oh, I apologize. This is a 0. My fault. If we reject the order, we're not getting any revenue from the order. Okay, that's there to kind of be tricky. Sorry about that. The variable cost is $24 each. Okay, so we're going to show, and again, if we don't make it, we're not having any costs, right? So believe it or not, the rejecting the order is 0 all the way down here. Okay, it's going to be 0, 0, 0. So now we're going to look at, all right, so the variable costs are $24. The export tax is 14% of the revenue. Okay, so I'm going to put 14% in this little box here, and we'll take the sale times 14%, $4.48, and this needs to be a cost. Okay, this needs to be added as a cost. Okay, so now we're going to find out what, okay, so we want an equal sign now. Okay, so we add all of this together, including the sales price. Are we still making a profit? We are. Not much, but you know, you could actually, for the heck of it, okay, for the heck of it, what was our profit? But let's just go ahead and put this in first. Okay, so if we reject it, none of these things happen. None of them. Okay, so this is all just going to be 0, 0, 0. Okay, so what it boils down to is the special price enough for us to either break even or still have a little bit of a revenue? If this ended up being a negative number down here, we probably would say no. Okay, so one more time, the new sales price is definitely going, and so it all boils down to how much the cost will be, the cost of our, and the fact that we had this extra tariff here, which wouldn't apply to our normal operations. Okay, so this is going to be $24, and then that tariff is 14% of revenue, so it's $4.48. Okay, and then down here we've got a profit of $3.52, and then we have a negative 24 and a negative 48, 4.8, 4.48. And so this number just happens to be the same. So basically, whatever you calculate here as accepting the order, if this is 0 or greater, it would be up to you to decide. Okay, the business. Maybe it's for something, Make-A-Wish at Christmas or something. I'm just really trying to depends on who's asking and why and what they're gonna do with it, you know, and so forth. You might actually win some sales or some loyalty by doing this, especially if it's for charity or something. So it's just a matter of if you decide to, but to my understanding, anytime that it's at least 0 or greater, you would say yes. Okay. So should the special order be rejected or accepted? I would say it is, should be accepted. You're still making a profit, not maybe as much as you normally do. But all right, let me check my work, make sure we're okay. Did I do this one here? Guess I didn't. Okay, let me check my work here. Okay, now we're ready for product price. Okay, so how do you come up with how a product price is calculated, right? So you take, lots of times you start with the cost of something, and then you do a markup, right? A markup of something, of a certain percentage. Most products have a markup industry standard, or the business will have it. Okay, we're Green Thumb Garden Tools. We produce and sell home and garden tools and equipment. A lawnmower has a total cost of $280. So I'm just going to put, let me read it and then we'll go back and put in information. So our total cost is $280 per lawnmower, of which $200 is product cost and $80 is selling and admin. In addition, the total cost of $280 is made up of $120 variable cost and $160 fixed cost. The desired profit is $20 per unit. Okay, so what we want to do, and there's a couple of formulas up here. There's the normal selling price, the product cost per unit, the markup percentage, the desired profit. They talked about a desired profit. There's also the markup per unit. So here's how we're going to work on this. Okay, we're going to divide the desired profit. Okay, so we want $20, right? Let's see. So okay. Okay. Divide the desired profit. The profit's $20 plus the selling and admin expense by the total product cost. So we're going to use markup percentage on product cost. Markup percentages, we're going to use this one. Okay, these are different ways of finding out prices, but this is the one they want us to use. Okay, so our desired product profit is $20, and our selling and admin is how much? It is $80. All right, so I'm going to just list these. All right, so our desired profit is $20 per unit. Okay, we have variable selling and admin per unit of $80. Okay, and then we'll put these in the formula. And then we're going to divide by 200, of which 200 is product cost. Okay, product cost. Total product costs. Okay, now this is total cost, but the product cost, okay, total cost. Here's the product cost, 200. So let's put that in. Okay. And now let's do our formula. So the markup percentage, that's what we're trying to find. What is the markup percentage on product cost? Okay, we're going to take these two numbers and add them together. Bless you. And then we're going to divide, right? So that's 100 divided by 200, right? So let's add these two together to get our numerator. Okay, equals, just showing that I'm doing the math here. Okay, there's $100, and then we're gonna divide by 200. Okay, so I think we're looking at 50%. Okay, so our markup percentage is, here's your numerator, here's your denominator, and we need it in a percentage. Oop. Okay, so it is 50%. Okay, so 50% markup, right? So 50% markup is what this is considered using this markup percentage. Okay, markup percentage. So 50%, I think should be right. Okay. If we want a profit, okay, markup percentage. Now let me see here. Oh, so cost amount per unit. So we could figure the selling price if we wanted to, but we won't because they're not asking us to. All right, last one. Here is a constraint or a bottleneck profit. I think that sounds kind of funny. Here's a couple of things about that. So it says we've got product K and product L. Okay, so I'm going to put both of those down. This is our last one. Okay, so product A. I can't seem to get my fingers to work today. And product L. Okay, let's put down what we know. So product K has a contribution margin. Remember, contribution margin is sales minus variable costs, right? So just for the fun of it, I want to put that down so we remember what it is. Sales minus variable costs. Okay, variable costs gives you a contribution margin. Okay, contribution margin. So we're going to put that amount in there. Roll this up. Okay. Okay, is your contribution margin. So we're going to put those amounts in for each one. This one isn't really hard. It's just, I want to make sure I explain it okay. So we don't know the sales price and we don't know, but we do know the contribution margin for each one. Okay, so product K is $161 per unit. Okay, 161. And then product L is $75 per unit. And I'll put contribution margin per unit. Okay, now what is the bottleneck? The bottleneck is product K requires 7 furnace hours. Product L only requires 3. So once again, a constraint is just like a traffic jam. Everybody trying to get through a stoplight. Only so many are going to get through at the same time, and others are going to have to wait. So we have 7 hours for this one. And this is what they call the bottleneck hours. Bottleneck. That's funny. Neck hours. Okay. This takes 7 and this takes 3. And that is not dollars. Okay. And so now what we're going to do, because here's how it goes. Okay. The unit contribution margin divided by the number of hours, the bottleneck hours. Okay. So we're just simply going to make this our numerator, and then our hours are the denominator. Okay. And then this is going to tell us, determine the unit contribution margin per production bottleneck hour. Okay. So let's do the math. 161 divided by 7. Oops. All right. Gives us 23. We're going to use that same formula. So contribution margin divided by 3. Let's put those numbers in. Now remember, contribution margin is positive. It's a revenue, right? It's a continuation of revenue. All right, so if we're bringing in $23 of contribution margin for K, but $25 for L, which one's more profitable? L. L is hanging on to more of their revenue per unit because of these bottleneck hours, right? This one goes through twice as fast, right? So anyway, that's it. That's all she wrote. Okay, and I'm doing this on video, so I'm going to stop my video here. Okay, guys, make sure you put your name in the chat. Okay, I'm really dependent on that now. So please do that, because when I go back through, I want to make sure I got your names. So, okay, I'm going to stop sharing now. We'll see you on Thursday. We'll finish up chapter 11. Okay? Okay. Thanks for coming in.
Thanks for having us.
Sure. I feel like, man, I just can't believe how quickly it's gone.
Yeah.
Some people are like, it can't come quick enough. So, see you guys.
See ya.
Reagan, if you find that problem, let me know.
Okay.
If you find it, because sometimes you just gotta know.
Yeah. All right.
And that's a good thing. That's a good thing. If your curiosity is bugging you, that's a good thing.
Have a good.
Bye, Cody.